Today, Norway keeps rates on hold, but the statement and monetary policy report took a very dovish tone. As projections are downgraded, I'm joined by Camilla Viland, analyst with DNB, to look at this data and more coming out of the Nordic region. So Camilla, Norway left interest rates unchanged today at 0.75%. This comes amid a renewed collapse in the oil price, which triggered cuts in December last year and September this year. Could this result have gone either way? And what does it mean if they hold off cuts until the first half of 2016, as they alluded to in their statement?
The decision today, it could definitely have gone either way. If you look back at what the central bank said in September, they signaled that interest rate was likely to be cut again, but not until the spring next year. So looking at that, it maybe was not that surprising. But still, expectations of a cut at this meeting had built up as international interest rates, they have fallen. And the effects of lower oil price and decline in oil investments in Norway is becoming more evident on the Norwegian economy. So as a result, including us, expected them to cut the rate now. The reason why they probably did not do it was that the development up until now has been more or less as expected. And they also are very clear that they want to proceed gradually with interest rate cuts. One reason for this is that they fear that even lower rates may increase the risk of house prices increasing rapidly and higher household debt, and this could again be a risk to financial stability. However, as I said, development up until now has been more or less as expected, but going forward, they believe that the outlook for Norway is weaker than before, so they have lowered their interest rate path, and they say it's most likely that the key policy rate will be cut in March and maybe even once more in 2016.
Also keeping rates steady this week was Norway's neighbour, Sweden, whose central bank left rates at a negative 0.35%. Riksbank has said it is serious about reaching its inflation target, and if more is needed to get there, then more will be done. Is the interest rate decision this week enough to get them to their 2% target?
If you look at the prospect for inflation in Sweden now, it probably will move up towards the target next year, but not stay there. The reason for this is, if you look back, the Swedish krona weakened both in the latter half of last year and the first half of this. And this weakening has not yet all fed through into the prices, so it's going to lead to higher imported prices going forward. And at the same time, the domestic price growth is expected to be stable. So inflation is likely to move upwards and probably reach about 2% in the first half next year. But note that this is likely to be temporary. If you look back now at the past few months, the SEK has strengthened again, and you may, looking forward even further out, get a reverse effect on the prices. And we believe that if you go to 2017 and beyond, inflation will be below target again. So it's probably needed for the central bank to do more, and we believe they may increase asset purchases again next year, because it's very important for the Riksbank now to prevent the Swedish krona, to get too strong, because that will be risk to the inflation outlook. So monetary policy will have to remain very expansive in Sweden.
Now, how are outside forces like the ECB and the Federal Reserve going to impact smaller central banks such as Sweden's and Norway's?
For the Scandinavian countries, they have stronger trade relations to euro. So what the ECB does, by far the most important. It's more important that the ECB has done more in monetary policy and will keep monetary policy expansive. And it will be important for the Scandinavian Central Bank to prevent interest rate differences or differences in monetary policy towards ECB to get too big, because then the Scandinavian currencies can strengthen. What the Fed does is not that important. However, it may have some indirect effects. For example, if higher interest rates in the US means that the dollar appreciates strongly versus the dollar, for example, if the euro weakens versus the dollar, it will be positive for growth in the euro area and for the inflation prospects, and thus it will reduce the likelihood that the ECB will have to do more in the monetary policy.
That was Camilla Viland, analyst with DNB, with me there, looking at the latest from Norway and Sweden. Now that's all from me for now, but don't worry, you can keep up to date with the latest news and data. Just make sure you're tuning in to Dukescopy TV. Bye for now.